Energy Transfer, ticker ET, is a company that operates in the energies industry, and over the past 5 years, the company has been climbing continuously. From its large drop in price in 2020, the company has risen up by more than 200% into the current time. Now, one of the reasons why this company is doing so well compared to its peers is that it's located specifically in the USA, and so issues that are present with many other companies which operate outside of the USA, such as mostly wars in the East, don't really affect Energy Transfer. Now, even though Energy Transfer mostly focuses on natural gas and doesn't really operate with green energy, which is becoming a large trend, there will always be need for natural gas in the next decades to come, so this doesn't really worry me that much. Another thing I want to point out with Energy Transfer is the population growth in the places where ET is mostly located. The company is located in the south of USA, which is the place with one of the highest population growth rates, which would mean that in time there will be more and more people Energy Transfer will reach without having to pipe their free cash flow into new infrastructure, which is always great. Now jumping into our stock valuation spreadsheet, we'll simply plug in the ticker ET for Energy Transfer and all the metrics will show up automatically. Now of course, if you do want to download these spreadsheets, you can always do so at my Patreon in the link in the description. Now right away we can see that ET does pay out a very juicy dividend yield of almost 8% with a dividend payout of $1.28 and quite a decent trailing free cash flow payout ratio of 56.09%. Normally I'd like the payout ratio to be below 50%, but 56 isn't anything horrific. Though if we jump to Seeking Alpha and have a look at the Energy Transfer's dividend history graph, we can see that they haven't increased their dividends over the past 5 years at all. About 5 years ago, the dividend was sitting at $0.31 and currently it's sitting at only $0.32. Now if I jump in the maximum graph, we can see that they have been increasing their shares steadily from 2008 until about 2016, but then they stopped. So when we jump to our 9-pillar analysis, we can see that the company is doing quite well. Currently it's actually trading dirty cheap. We generally want the P ratio to be below 22.5. ETS is currently sitting at 9.02, as well as the price to free cash flow, which is currently sitting at only 9.36. So again, Energy Transfer is trading really cheap compared to their earnings per share and compared to their free cash flow per share. Now when we have a look at this metric right here, the long-term liabilities of the 5-year free cash flow negative dividends, we can see that that is currently sitting at 6.56, which means that ET would take about 35 years to pay off all their current long-term liabilities. Now when we scroll down to the graphs and have a look at the free cash flow and the long-term liabilities, we can see that although the free cash flow is growing very well, the shares outstanding are growing by quite a bit as well, and the long-term liabilities aren't really decreasing that much. So this is one of the reasons why I think that ET won't really be raising their dividends that much over the next few years, as they will need to pay off their long-term liabilities. And of course, as they are selling out more shares, they have to pay out more in dividends, so that only contributes to them not raising their dividend. Now scrolling back up, apart from this, ET has been growing their revenue, they have been increasing their free cash flow, and they have also been increasing their net income. This metric is wrong. If we scroll down to the net income, we can see that over the past 5 years, there's a clear trend in the increase of net income. But now we can jump to calculating the intrinsic value of Energy Transfer, first using the Graham's formula revised. And as mentioned before in the 9-pillar analysis, ET is currently trading very cheap, and therefore compared with the 5-year growth estimate, the intrinsic value comes out to be very high, 63% higher than the current trading price of the company. Though if we do move to our discounted cash flow model, where we plug in the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 65%, now based on the average growth rate and the analyst growth rate projections, I will project a modest growth rate into the future of 6.2%, and using that I will calculate the future free cash flow. I will then plug in the discount rate at 9%, only slightly higher than the current WACC of the company, and using that I will calculate the present value of all of that future free cash flow. I will then sum it up add cash and cash equivalents, subtract total debt, and get an equity value. And to get the intrinsic value, we have to divide the equity value with the shares outstanding, and by that we'll get an intrinsic value of $22.72, which is slightly higher than the current trading price. Now in our multiples valuation, we want to compare Energy Transfer to companies which operate in the same sector. So we will take these three companies, we will take their current stock prices and divide by their earnings per share to get their PE ratios. We will then average out these PE ratios and multiply by the earnings per share of Energy Transfer to get an intrinsic value of $17.26, about $1 higher than the current trading price of ET, showing us that compared to its peers, Energy Transfer is fairly valued. And finally, moving to our last valuation model, the dividend discount model. Here we will take the growth rate of the dividends over the past 5 years and calculate the average growth rate to be sitting at 10.18. But as we saw in Seeking Alpha, the dividends were growing over the past 3 years, but over the past 10 years they haven't grown by that much. So I will project a growth rate, quite a modest growth rate of 3% into the future. And by doing that, we'll get an intrinsic value of $21.72, which is again quite higher than the current trading price. And now to get to our ultimate valuation, we will average out the four models and get an intrinsic value of $26.32, which is 63.92% higher than the current trading price. So even if I plug in a margin of safety of 20%, I will still get an acceptable buy price at $21.06. Now if I were to remove the Graham's formula, the outlier, I would still get an intrinsic value of $20.56 based on the three other valuations we did. So I truly believe that Energy Transfer might currently be undervalued, and now might be the best time to buy the company for future growth. And with that, if you did enjoy the video, make sure to leave a like and let me know down in the comments which company you'd like me to evaluate next.